Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Monday, January 8th, 2024. Happy New Year. Welcome back to the podcast, George.
Happy New Year to you and to our listeners, and great to be back on, as always, a new year.
Yeah, great to have you. Feels a little weird saying 2024, but I guess that's how things go. I suppose I will get used to it. On an administrative note, I'd like to not remind our listeners, but let our listeners know that this podcast is the first episode of a special three-part series where George and the authors of the MUFG 2024 Outlook, Getting Back in Sync, go over their piece in podcast form. So today's episode will be available on Tuesday, January 9th, followed by an episode on mortgages that will be released on Wednesday and credit on Thursday. So definitely stay tuned for those. So let's see. Let's switch to some content here. George, during the last 2 years, one of the common intros that I think you often said in these episodes was that each day, each week, each month seemed more intense than another. You know, a week felt like a month, and a month like a year, et cetera. In that vein, and as we kick off 2024, what are the key themes that you're looking for over this upcoming year?
Thanks, John. Look, this has been really with us since post-pandemic, where each year has been new information and just new things for the markets to digest. Last year coming out much stronger than expected, unemployment rate remaining low, inflation declining, spending solid, generally a much stronger than even what we were expecting in terms of growth. A lot of it aided and abetted by the fiscal policy. It really sets up for an interesting 2024 because, on the one hand, we're always kind of navigating these narratives, and so the last 2 months of the year really kind of set the stage for some pretty high expectations and high hurdles, in my opinion, for what 2024 might look like. We had a pretty big rally in risk assets, a decline in rates, tightening of spreads. In many ways, we call it price to perfection. And so when you're starting from that point, I think it matters. It makes your hurdles a little bit harder as we start off this new year. Look, this year for us is a year where I think we go back to the pure fundamentals. We have less fiscal support on average relative to prior years. A lot of the sort of emergency and pandemic-based stimulus measures have largely kind of run their course, and now the consumer is really back to fundamentals on earnings potential as well as credit availability. I think this is where we're going to really find out, like, what is the true tempo of the U.S. economy. Meanwhile, we have what I consider the big four, which is the Fed, government spending, banks, and then the private side of the economy, which comprises of small businesses, corporate America, private lending, things that are outside of the banking system, which is regulated. So you have the Fed, government, bank system, and the private sector. Those are the big sort of drivers of economic activity for the economy. And 3 out of 4 are really not pulling their weight. And we have the Fed that's still very restrictive, although they are now in the process of pivoting towards what we think is going to be, a decent easing cycle. They have yet to cut. So, the timing could be off, and we don't know what would it take for them to cut further and to really try to rescue the economy from going into a much slower backdrop. And the government last year, fiscal spending was pretty substantial on the back of various programs and policies that happened in 22 and into 2023, notably the infrastructure program and the Inflation Reduction Act. A lot of that is kind of now already baked in, and we're not going to see a big enough growth momentum on government spending relative to what we saw last year. And then there's the banks, which have basically stopped lending. So Fed is restrictive, not easing yet. Government probably has not much in the fiscal tank to add more stimulus to the economy at this point, and the banks aren't lending. So really, we're at the mercy of, like, can the consumer stay robust? We'll spending continue at the pace that we saw, or are we going to start to see a slowdown? And then, how does the labor market fit into that? So I think these are the unknown questions that we're trying to solve. And we got some early indications starting last week in the January data, or the data from December that was released in the first part of January, which is starting to again highlight and shed some light on the fact that maybe the jobs market is not as strong as people think it is. So look, it's for those reasons that we have maintained our view around that the more likely outcome still is some sort of bumpy landing, potentially verging on a mild recession. But in the course of that, we shouldn't expect policymakers just to sit there and wait to get proof that we're in a slowdown. I think the Fed pivot is because they saw something that we probably don't see in the jobs data. There's still concerns around the banking system, and I think that they're going to start to ease and try to soft land the economy. But along the way, it's going to get bumpy, and so I think this is our message. It still remains as such. If we avoid a actual outright recession, our next best case scenario is more of a kind of a stagnant growth environment with not much inflation. And we're not in the Goldilocks camp, which is, again, really at odds with what was priced in to perfection in the last 2 months of 2023.
Yeah, and which seemed pretty amazing to me. To put some numbers on it, I believe you were assigning a 55% chance to a recession. And you've said that the stagnation and stagflation scenarios are more likely than the Goldilocks. Is that right, George?
That's right. Those remain our base case views. And people have, of course, recessions are not something to take lightly, but recessions happen all the time. And we've had mild downturns, and that's really what we're calling for, not for a hard landing akin to 2020 or 2008. This is more of an adjustment process where the malinvestments and the weaker credits that were business models built on low rates and tight spreads, I mean, those will slowly continue to kind of have a controlled burn through the economy, which will result in some of those businesses going away, which we've had a decent bankruptcy already in 2023. That probably continues into 2024, and that will then result in eventually delinquencies picking up further and actual defaults in the super more riskier side of the credit spectrum. At that point, the Fed's not going to sit around just waiting. We think they'll be aggressively easing into that, which is why we have 175 bits of cuts with upside, not downside. So we think that our house view is that they will still cut in March. It's now becoming more of a 50-50 type of situation. But I think we do believe that the sooner the Fed gets ahead of this, the more likely we can actually have a more stable growth in the back half of 24 into 2025.
Yeah, you were really early to that call. I think if I'm not mistaken, you had that call in the summer to have that first cut in March 2024. Certainly looking a lot more likely at this point. But very interesting to see how well markets are priced here, as you said earlier in the episode. Given your outlook, which in a mild recession, at this point with rates as high as they are, as restrictive as they are, that certainly seems like a reasonable expectation. But we could really talk about this for forever. But what I would like to do is instead direct our listeners' attention to your recently published U.S. debt strategy piece, 2024 Outlook, Getting Back in Sync. And for our listeners, if you are still not receiving George's strategy reports directly, there is a new way to get them. You can check them out as well as other MUFG research on the new MUFG research portal, available at www.mufgresearch.com. And you can also sign up to receive your favorite research pieces directly into your inbox. Great stuff as always. Thanks, George.
Thanks, John. Thanks for having me on.
My pleasure. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.